Good morning, everyone. Thanks for joining us as we dive into one of the most talked about stories in the financial world this week. Oil prices have been on a wild ride this week, with both Brent and West Texas Intermediate dipping on Friday, September 19th, 2025. The markets have been anything but calm, and investors are watching every move with bated breath. Brent crude fell to just over $67 a barrel, and West Texas Intermediate dropped to around $63. These numbers mark a significant shift from earlier in the week, when prices were climbing steadily. Despite the dip, prices were still set to finish the week higher than they started, a true roller coaster. The ups and downs have left traders and analysts scrambling to make sense of the rapid changes. This volatility is driven by powerful forces pulling the market in opposite directions. It's a tug-of-war between supply, demand, and global events that can shift the balance in an instant. On one side, factors are pushing prices down. On the other, strong currents are keeping them up. It's a delicate balance, and even small changes in the news can tip the scales. Oil prices impact everything from gas at the pump to grocery bills, so these shifts matter to all of us. Whether you drive to work or buy food at the store, you're feeling the effects of these price swings. We'll break down what's happening in the US and globally to help you understand the story behind the numbers. The oil market is a complex web, influenced by everything from geopolitics to weather patterns. The main reason for Friday's dip? Growing concern about US demand. As the world's largest oil consumer, what happens in America sends ripples across the globe. When people expect to use less oil, prices fall. Lower demand means less pressure on supply, and that can quickly drive prices down. Right now, all eyes are on the American consumer and economy, with signals suggesting our appetite for fuel might be shrinking. High interest rates, inflation, and changing travel habits are all playing a role. That sent a wave of caution through global oil markets, making this a key part of our conversation today. Stay with us as we unpack the factors shaping oil prices and what they could mean for your wallet in the weeks ahead. So, what's behind the worries about US demand? It's a question on the minds of drivers, analysts, and oil producers alike, as everyone tries to make sense of the recent shifts at the pump. The biggest factor is fear of an economic slowdown. When businesses close their doors or cut back on hours, it sends ripples through the entire economy, affecting everything from jobs to consumer spending. When the economy cools, people drive less, factories slow down, and fuel use drops. Trucking companies may run fewer routes, and airlines might cut back on flights, all leading to less demand for gasoline and diesel. We're also moving past the peak summer driving season. Those road trips and vacations are winding down, and so is gasoline demand. As families settle back into their routines, the need for long drives and travel decreases. This seasonal drop is expected, but it's adding to the downward pressure on prices. Gas stations are adjusting their prices to reflect the lower demand, and drivers are starting to notice the difference. The job market is another concern. Recent signs of cooling mean less consumer confidence and spending. When people worry about job security, they tend to cut back on non-essential travel and expenses. Fewer jobs and more caution mean less driving and less fuel used. This cautious approach can be seen in quieter roads and emptier parking lots across the country. Even small changes in employment can create big waves in the oil market. Traders watch these trends closely, knowing that shifts in demand can quickly impact prices worldwide. All these factors point to potentially weaker demand in the world's largest economy. The US sets the tone for global oil consumption, so any slowdown here is felt everywhere. Oil markets are preparing for lower fuel use, which is a powerful force behind the recent price dip. Storage facilities may see higher inventories as less fuel is moved out. Despite global events pushing prices up, US demand concerns are pulling them down. It's a complex balancing act, with international tensions and local realities both playing a role. That's the tug-of-war we're seeing at the pump, where every fill-up reflects a mix of global headlines and local habits. Let's look at the numbers making experts cautious. The latest economic data is painting a picture that's hard to ignore, and it's sending ripples through both the energy and job markets. The latest US government report showed a sharp increase in distillate stockpiles, fuels like diesel and heating oil. These are the fuels that keep trucks moving, factories running, and homes warm during colder months. When stockpiles grow, it means more fuel is being produced than consumed. This imbalance is a clear signal that demand is weakening, even as supply remains steady or rises. This suggests the trucking industry, a backbone of our supply chain, is slowing down. Fewer goods are being shipped, and transportation companies are feeling the pinch. Fewer trucks on the road means less diesel used, a sign of a cooling economy. When the demand for shipping drops, it often means businesses are selling less, and consumers are buying less. The jump in distillate inventories confirmed fears that economic activity is tapering off after summer. Factories are producing less, and warehouses are seeing fewer shipments. Job market data adds to the concern. Hiring is slowing, and that means less consumer spending and travel. Fewer new jobs means more uncertainty for families and less confidence in the economy. Families cut back on trips, businesses scale back deliveries, and fuel demand drops. The ripple effect touches everything from local tourism to national freight. Rising fuel stockpiles and a softening job market together create a strong case for lower oil prices. Investors are watching these trends closely, anticipating further declines. These hard numbers back up the sense of a slowdown. It's not just a feeling. There's real data behind the headlines, and it's shaping market expectations. For the global oil market, U.S. data is a critical barometer, and right now it's pointing to cooler times ahead. What happens here often sets the tone for energy markets worldwide. That's putting real downward pressure on oil prices, and it could mean cheaper energy for consumers, but also more challenges for producers and workers in the industry. But just as prices seem set to fall, another force steps in, the U.S. Federal Reserve. The Fed recently cut interest rates, sending a strong signal to markets worldwide. Lower rates make borrowing cheaper, encouraging businesses to expand and consumers to spend. More economic activity means more energy use and more demand for oil. The Fed also hinted at more cuts if needed, reassuring investors that support is available. This optimism acts as a safety net, countering fears of slowing demand. For oil markets, the Fed's actions help balance out the negative data. It's a battle between current weakness and future hope. The present looks gloomy, but the prospect of a stronger economy down the road is keeping oil prices from dropping too far. The Fed's moves are a crucial layer of support. That's why oil hasn't crashed, despite all the warning signs. Beyond economics, geopolitical tension is keeping a floor under oil prices. Instability in key oil regions makes traders nervous about supply disruptions. Even the threat of conflict can drive prices higher. Think of the oil supply chain as a network of highways. Any roadblock causes a traffic jam. Geopolitical conflicts, like the war between Russia and Ukraine, are major roadblocks. Russia is a top oil producer, and any escalation in the war raises fears about its exports. Traders watch every development, betting on whether supply will be disrupted. This constant risk adds a premium to oil prices, keeping them higher than they'd otherwise be. The risk premium balances out U.S. demand concerns. While American data suggests less oil will be needed, global turmoil suggests less oil might be available. That's the tug-of-war defining the market right now. Weekly gains in oil prices, despite the dip, are fueled by these geopolitical jitters. The Russia-Ukraine conflict is a key source of oil market volatility. Every new attack or diplomatic breakdown is scrutinized for its impact on oil flows. Even the possibility of disruption is enough to move prices. Traders buy oil futures when fighting escalates, betting on tighter supply. This surge in buying, driven by fear, pushes prices up for everyone. Russia's role as a major supplier is under a global microscope. Sanctions, boycotts, and shifting trade relationships add more uncertainty. Will Russia cut production? Will new sanctions hit exports? These questions keep markets on edge. The war has introduced a persistent fear premium into oil prices. That's why prices remain high even as U.S. demand weakens. The economic story pulls prices down, but geopolitics pulls them up. As long as the conflict continues, this tension will keep oil markets unpredictable. While U.S. demand and Russian tensions dominate headlines, other global developments matter too. Kazakhstan recently resumed oil flows through the BTC pipeline after a month-long suspension. This alternative route bypasses Russia, diversifying global supply and easing market tightness. The pipeline's return puts gentle downward pressure on prices. In Nigeria, the government lifted a 6-month state of emergency in its oil-rich Rivers state. Stability in this key region reassures markets that Nigerian oil will keep flowing. These positive developments help balance out fears of disruption elsewhere. When major hubs are stable, traders feel more confident about supply. Stories like these may seem small, but they add up. They provide pockets of stability that moderate the risk premium. The result? A more balanced, less volatile oil market. Even small news from producing nations can tip the scales. It's not just data or conflict. World leaders' words can move oil prices too. Recently, former President Trump called for lower oil prices to pressure Russia and end the Ukraine war. He argued that lower prices would shrink Russia's income, making it harder to sustain the conflict. This turns oil from an economic indicator into a geopolitical tool. When leaders make such statements, traders and policymakers pay attention. These comments can shift market sentiment and add political pressure on OPEC+. Calls for lower prices may create expectations that producers will boost supply. Oil is more than a commodity. It's a strategic asset in global politics. Leaders' words add another layer of complexity and uncertainty to the market. The price of oil is shaped by opinions and political goals as much as by supply and demand. After all this, why does it matter to you? Oil prices directly impact your daily life and household budget. When oil prices dip, gas gets cheaper, leaving more money in your pocket. But oil costs are built into almost everything you buy. From farm to grocery store, every step uses fuel, and those costs get passed on to you. High oil prices mean higher transportation costs, leading to inflation at the checkout. Rising energy costs squeeze budgets for businesses and families alike. This can slow the economy as everyone cuts back to cope. That's why we watch oil markets so closely. Understanding the tug-of-war between U.S. demand and global supply fears helps us anticipate what's next. The recent price dip offers hope for relief, but global tensions keep things uncertain. It's a global story with local consequences. Staying informed is your best tool for navigating what comes next.